Some assets and liabilities are volatile, and their fair values may change drastically. This could have serious negative consequences if the fair value changes are unfavorable. So entities take out fair value hedges to protect themselves from drastic changes in the fair value of their recognized assets, liabilities, or unrecognized firm commitments to purchase or sell a resource. For example, Cornwall Limited is a company that holds inventory of corn. The fair value of corn has been fluctuating in recent years, and Cornwall Limited want to protect itself against this by taking out a forward derivative contract to sell some of the corn at a set price. Assume Cornwall took out a forward derivative contract on the 1st of January to sell 50,000 tons of corn on 31st December for $100 a ton. The hedged item would be the corn whose fair value fluctuates. The hedging instrument would be the forward derivative contract, which secures the price and offers a level of protection. Let's look at the theory of how this should be treated over the next 12 months. The inventory of corn would still require fair value adjustments. However, the opposite movement would be recorded. IFRS 9, paragraph 6.5.8 requires the gains or losses on the hedging instrument and hedged item to be recognized in profit and loss. However, gains or losses in fair value of equity instruments should be recognized in other comprehensive income. Assume that on the 1st of January, the fair value of corn was $4.7 million and the fair value of the forward derivative contract was $0. On 30th June, the corn inventory had a fair value of $4.9 million and the fair value of the forward derivative contract was a credit balance of $150,000. On 31st December, the fair value of the corn inventory was $4.8 million and the fair value of the forward derivative contract was $200,000. What would be the journal entries on the 1st of January, 30th of June, and 31st of December? On the 1st of January, there would be no journal entry since the fair value of the forward derivative contract is $0. On 30th June, the fair value of the corn increased by $200,000. So the journal would be to debit corn inventory to increase it by this $200,000 and a credit to a gain in profit and loss by the same amount. Note that the gain on the hedged item is taken to profit and loss. On 30th June, the fair value of the forward derivative contract decreased by $150,000. So the journal would be a debit to a loss in profit and loss for $150,000 and a credit to the forward derivative contract with $150,000. Note that the loss on the hedging instrument is taken to profit and loss. On 30th December, the fair value of the corn inventory decreased by $100,000. So the journal would be a debit to a loss in the profit and loss with $100,000 and a credit to corn inventory to decrease the inventory to its fair value. On 31st December, the fair value of the forward derivative contract increased by $350,000 to get to a fair value of $200,000. Note that the $350,000 increase is the movement in the balance from negative on 30th June to a positive on 31st December. So the journal would be a debit to the forward derivative contract with $350,000 and to credit a gain in profit and loss with the same amount. $200,000 is the fair value of the forward derivative contract on 31st December, which is also the maturity date. Because this is a positive balance, it indicates that Cornwall Limited will be receiving this balance. So the journal would be to debit bank with $200,000 and a corresponding credit to the forward derivative contract. To recap, fair value hedges protect against the exposure of fair value changes to recognized assets, liabilities, and unrecognized firm commitments to buy or sell a resource. As a general rule, gains or losses on fair value hedge items and instruments are taken to profit and loss, unless the item being hedged is an equity instrument, in which case the gains or losses are recognized in other comprehensive income.